Hi, this is Josh Haggerty. I hope this message finds you well. As we're approaching the end of the third quarter, we thought we would try a new format, maybe something a little more interesting to digest market information for 2025. So as we head into the fourth quarter, we're looking at stocks that are slightly elevated. The bond market, if we look at the 10-year Treasury yield, started the year around 4.6% and is down to 4.2%. And the Fed has started cutting interest rates again, first with a 25 basis point cut, and now expectations are for potentially another two between now and the end of the year. Things that we'll be monitoring between now and then are the rate of inflation, which has come down, but there are some signs of possibly inching higher. That will certainly be impacted by any lingering impacts from tariffs that have yet to be seen in the economy. We're also watching the labor market, which has weakened significantly. The last labor report showed negative job growth in June, and the 3-month average is the lowest in 20 years. So as we head into the fourth quarter, the question is, where are we now and what should we do? So as we think about the equity market and where there might be some opportunities, we think about the broader S&P 500, which you hear on the news every day. That index has 500 stocks in it, but they are market cap weighted, so the bigger companies get a bigger weight in the index. And so right now we have a record concentration where the top 10 companies represent 39% of the index. That is creating a certain level of concern for investors. On the other hand, unlike the technology bubble, when many of the largest companies were trading at excessive valuations, they were borrowing money to invest in growth. The companies today that represent those top 10 are very successful companies generating a lot of cash flow, and so they represent a third of the earnings in the S&P 500, not too different than their market cap weight. From our perspective, these are companies, for the most part, that you want to have some ownership in, but we're not recommending you put 39% of your portfolio into these 10 companies. I'm sure you've heard us talk about our key thematics when it comes to stocks. We're continuing to focus on dividend growth, which has historically held up really well in more difficult markets. And so that gives us a little more comfort to be investing in that area of the market when the overall valuation is back in the top decile. And then for those that are looking for a little more capital appreciation, we still like companies that are higher quality and that have growth but trade at more reasonable valuations. In the bond market, we've got credit spreads, which is the spread on a corporate bond to the risk-free treasury at the tightest level since 1998. So on one hand, that suggests there's not a whole lot of opportunity in the bond market. On the other hand, yields are still relatively high versus what we've experienced the last 10 years. So similar to the stock market, we think in bonds staying the course and not taking too much risk is the right course for now. As we head into the final few months of the year, we will be continuing to look for individual opportunities to improve the risk reward for your overall portfolio. Obviously, we'll be looking to minimize your tax bill for 2025 and reaching out with any recommendations to reposition portfolios as we head into 2026. Thank you so much for watching this video. If you have any feedback, please provide it, as we're always looking for better ways to communicate with you. And as always, if you have any questions or concerns, don't hesitate to reach out.